Well, our next session, we're so pleased to have the support of PwC and building on a year-end report in M&A and an outlook for 2014 that they delivered at our summit in New York in December. Very pleased to welcome Steve Fleming from PwC.
Thank you for being here at PwC's 2014 Distressed Investing Outlook. But first off, I'd like to apologize on behalf of Perry Mandarino, who unfortunately needs to be in court today. Apparently he thinks I know enough to moderate this session, so you have me here instead. I realize that we are the 5th session this morning, and we are all that stands between you and lunch. Having said that, we have a very diverse panel here that has some really interesting insights to share about the market in 2014 and beyond. Their backgrounds include private equity, investment banking, and financial advisory, as well as legal. So with that, let me start off by introducing our panel.
Good morning. My name is Durc Savini. I lead the restructuring practice at Peter J. Solomon.
My name is Duncan Bourne. I'm a managing director at Wynnchurch Capital in Chicago.
Hi, my name is Brian Urbanik. I'm a managing director at Sun Capital Partners in Boca Raton, Florida.
Hello, my name is Brian Davies, managing director at Capstone Partners.
Good morning. I'm Cathy Reece. And I'm the chair of the Bankruptcy Group at Fennemore Craig in Phoenix, Arizona, with offices in both Phoenix and the other cities in Arizona, plus Nevada, and also Colorado. So we're a mountain state and southwestern law firm.
Thank you. And I'm Steve Fleming. I am part of PwC's Business Recovery Services practice based out of New York. Okay, so as we've already heard in the other sessions this morning, it's a real interesting time in restructuring. So I'd like to start off with Duncan, Duncan, where or what opportunities do you see that lie ahead in 2014?
Well, it's a sort of not a long talk I'm going to give here about where the opportunities are in 2014. I think we've heard from earlier panels this morning that easy credit is making it fairly tough to find attractive distressed deal opportunities. Easy money really is the enemy of finding well-priced distressed deals. I happened to be yesterday with a competitor of ours. They basically do exactly the same stuff that we do, though we'd never admit that to an LP. But that, he said, private equity distressed investing really stinks right now. Stinks is actually a quoted word from this guy. He said, it's a great time to be a seller, and he's a seller. It's not a very good time to be a buyer. On the restructuring side of things, we are hearing about a few more covenant issues, but generally these seem to get resolved, some pretty easily and some with greater difficulty. But if they don't get resolved, I think we'll continue to see stakeholders, lenders, creditors, equity sponsors, investors like ourselves, avoiding the cost and time of a Chapter 11. So, trying to achieve a negotiated settlement instead of going into Chapter 11. And then I've heard too, there's going to be, maybe some uptick in activity from interest rates increasing to help jumpstart the whole thing. But I don't think so. I think that we'll see gradually increasing interest rates. I'm not sure that we'll see a fast jump. I think that's being driven by lenders. I think, for example, again, I was with a bank group head, ABL lender yesterday, talking about what he's seen in his business over the last year. And he said, listen, they're experiencing a fairly heavy degree of yield compression right now, which is essentially taking money out of their pockets. And so, management's response is, we got to get more loans out on the street. And so lenders are continuing to be very aggressive. They have targets to increase and expand their business and generate greater profitability. So I think easy lending is going to be here for some time to come.
Thank you. Brian, how about from a financial advisory perspective?
Yeah, I agree with a lot of what Duncan was saying. Everybody in this room has been in this business for quite some time, I assume, and we've all been waiting for that next bubble in the distressed business to kind of pop again, and it just hasn't come. the easy money's out there, low interest rate, covenant light deals. They'll continue to be challenging and force us all to be creative. I think we all believe that it's got to come at some point. At some point, interest rates have to move, which will change industries, and you know, they're industry specific. A lot of them named today already that we have to focus on, knowing that there's going to be decrease in defense spending, how that's going to affect, you know, the ancillary the businesses within defense, and those things, you know, continue to be creative until, you know, interest rates move, until the economy starts going up. You know, somebody told me about 15 years ago, who had been in the restructuring business long before there was a restructuring business, that the only time you make a lot of money in the business is at the very bottom of the economy, or at the very top of the economy when it's going down. And I think we're still at the bottom, and I'm not sure when we're going to start going up. When we start going up, I think we'll all get busy again. Until then, I think we're going to have to continue to be creative in what we do.
Thank you. Cathy, how about from a legal perspective?
Well, I think my view might be slightly different from Duncan, who's private equity, or Brian, who's turnaround, because representing a variety of buyers and sellers of assets, of distressed assets and distressed debt, what I've been able to see is probably even more industries than they've seen. In my part of the country, which I said was the Mountain States in the Southwest, we've seen a number of hospitals, for example. There have been 6 hospitals that in just the last 18 months have had to be either closed or put up for sale. They're mostly in the rural areas where you would expect some problems compared to the high research facilities in the downtown areas. There have been a number of condo projects which have failed. Hotels, even though our tourist industry has continued to be good and strong, when it's cold up north, hint, and it's warm in Phoenix, the hotels still, there's a certain number of flags that are still having a problem in Arizona. And then, of course, there's a lot of raw land that's still available, and there are home builders who have money who are looking for land to buy so they can land bank that for their next projects that are coming up. And then in addition, golf courses in Arizona and across the Southwest have continued to have problems and had to either be restructured or to be sold. And so I think there are a good number of opportunities both in 2014 and even into 15 with these types of assets that are there. There are also junior mines, which when you think about the price of copper or gold or some of the other metals, there are mines that are experiencing trouble that are up for sale as well, and so as a distressed asset. And so I think the number of opportunities just are different for my industry as a legal advisor.
It's an excellent point.
Steve, I mean, I'm not saying, though, that there aren't any deals out there, and there are deals out there. I guess you have to, you know, find them. And I think, you know, like we play a lot in the lower middle market space, and so there's still a lot of things in the lower middle market, but they're tiny companies. They're not big companies, you know. So, you know, bigger deals, you know, 100 million plus in debt stuff, that's tough to find, right?
They're tough, there's no question about it. Look, a lot of the people in our business generally lament the fact that restructuring activity just isn't as significant as it was in the past, and it's, in fact, by a number of different measures, as low as it's been since people have started tracking restructuring activity. Having said that, what that means is you just can't look broad. You have to look very narrowly for secular opportunities for idiosyncratic failure. And one way to do that is to frankly look at all the speculative grade debt out there. Look at it by industry sector. Look at it by which industry sectors are showing the greatest negative bias. So sometimes we do that. And when you look at the highest negative bias by industry sector, by low speculative grade credit rating, you see things like retail and consumer, media and communications, primarily publishing, some things that have more or less played out, but there's still some risky debt in there that likely will, not because of interest rate factors, but because of continued operating problems, become restructuring opportunities for us. A lot of people in our business all like to look at the leverage, the pro forma leverage statistics, and people are starting to get excited about the fact that for the first time recently, pro forma leverage statistics for speculative grade companies have exceeded the pre-crisis level about 5.5, 5.6 times. The bad news is that cash flow coverage of debt service or fixed charge coverage is more than twice as high as it was back then. So what that means is you're going to have to have a disproportionately large shock operationally or otherwise, to actually have a company get into financial distress over debt service issues. So and we've heard a lot of people talk about 100 or 200 basis points. It's going to be 500 basis points plus if you're going to have an interest rate related problem with these companies.
Yeah, I mean, like in the last year or so, or a couple of years, you know, there's always distress that you find in sort of like frothy stuff. I mean, people get too excited about something, things get frothy, and then something goes wrong, right? You have one of these type of shocks.
Sure.
And you know, in the oil and gas market right now, it's pretty frothy, right? Oil prices have been pretty high. People have been making a ton of money down there in Texas, and so there's lots of dollars flowing down there, a lot of investment dollars flowing down there, and just sort of as an indicator of sort of what happens in the oil and gas space. You know, last year in Canada, there was a business called Poseidon that went into receivership up in Canada. Actually, it was a CCAA is what took place. And that was a business that said, boy, you know, we've got this whole new great technology for how to transport and store water used for fracking gas wells. And basically what it was like you went to Home Depot and you get an above ground pool, like one of those circular things, you stick it in your backyard temporarily. What Poseidon was a really big above ground pool that they could truck around, and they claimed that this was groundbreaking, amazing technology. And they said, yeah, we can take it out of the Bakken, we can take it over to the Utica, we can take it down into Texas and Oklahoma and do it down there. And so stock prices went crazy. But what was wrong with it, though, is that people forgot about taking a look at whether or not the cash flows of the business actually made sense. And that turned into a big bust. There was another one, I think, called Greenfield down in Louisiana that was a big bust. You know, sort of new technology, environmentally friendly way to do fracking. Put a lot of money into it. Shell was the buyer of the technology. And that didn't really end out very well. And basically that went into a liquidation. So it's those kinds of things where a lot of froth, not really great underlying fundamentals of the business, where there would be, you know, in some cases liquidation, but in some cases some opportunities for distressed investors.
Well, and following up on what Duncan said, another area that reminds me of is where there is a lot of fraud. And as we know, fraud continues to be prevalent throughout the country. In the Southwest, the elderly people tend to be taken advantage of, and they're put into investments that they have no business going into. And so we've had several affinity fraud cases, and both Utah, Nevada, Arizona, Texas, California tend to be very high for these types of affinity fraud cases. And with the affinity fraud cases come the opportunities for the assets to be collected under a trustee or under, you know, a plan of reorganization to then be resold. And those then tend to be distressed assets that buyers will be very interested in, as those assets are liquidated for the benefits of the investors and the elderly people. So if you talk with the SEC, individuals, the compliance people in these various states, you'll realize that there still is an awful lot of that type of fraud going on that will create opportunities for buyers as well.
I think the one other thing that Duncan mentioned that's worthy is the smaller the deals in the lower middle market, the more opportunity there can be from the private equity perspective, because a lot of times it's bank lenders that want to get out of the credit and negotiate. Where when you get into larger restructurings, like Durc probably works more on, there's a lot more sophisticated base of hedge funds that will take over companies that maybe 10 years ago they wouldn't have done. They'll do that a lot more now. So from a private equity perspective, the deals aren't there as much, or they're too expensive. You can't get your arms around the returns or the risk profile.
And then finally, you and I both do these types of deals. There are corporate carve-out deals that are out there. Now, these aren't bankruptcies, but they have everything else, like a restructuring. Oftentimes, there'll be a troubled business inside of a larger corporate owner's portfolio of companies, underloved, undermanaged. In a lot of cases, negative EBITDA situations, and so you have to have a pretty good stomach to get involved in these things. But those can be good opportunities. We do a fair number of those, and I think you guys do as well.
Yeah, we absolutely like corporate carve-outs or other types of special situations with businesses going through transition, with entrepreneurs or those types of businesses that have a higher risk profile, don't fit down the fairway of a typical private equity firm. but give us an ability to go in and improve operations like a typical distress situation.
Yeah, sort of everything like a bankruptcy, but not really. But without the bankruptcy, it doesn't have the Chapter 11 or the UC9 sale or anything like that.
Great. So now that we've commented on some of the opportunities, Cathy, can you share some insights on what you think may be some of the hindrances or pitfalls that we may encounter as we look ahead?
Well, I thought of three things to kind of share with the audience that are pitfalls for you. One of the things is that depending on what state you're in or what district you're in, there is a real turnover of bankruptcy judges that are retiring during the last year, during this year, and the next year. And so there could be a certain amount of uncertainty based upon new bankruptcy judges on the bench. So keep that in mind, ask those types of questions, think about that. Second is that there is a certain amount of legal issues that are at the state level that you need to keep your eyes on depending on where the assets are that you want to buy in a distressed industry. For example, Nevada is one that you need to be aware of, where there is a statute that has been passed where parties that buy commercial debt, they buy the debt from the lender, can only enforce the debt for the amount that you paid for it. You don't have the ability to get an unsecured claim or to enforce your unsecured claim above that amount. It's like an anti-deficiency statute. You are limited to the amount of what you paid for the debt. That then, and there's a receivership case out of Nevada where the receiver, the anti-deficiency that applies in a situation where you're trying to sell an asset and the lender credit bids a certain amount in a receivership. There's an anti-deficiency statute in Nevada, Arizona, and in many other states. And the question is whether when a receiver sells it, as opposed to a foreclosure, you are going to be limited to that amount. Again, what you have actually paid for that asset. And so that's a growing issue in receiverships that could come up in other states, not just our part of the country. But then the third thing is I wanted to talk about the Fisker case for just a second. It was mentioned briefly 2 panels ago. But for buyers of distressed debt, I think you need to be aware of the Fisker case. It was the Fisker automotive case out of Delaware. And the issue there really wasn't just whether or not the credit bid is going to be limited to the amount that the buyer paid for the bank debt. Because most courts across the country do allow full credit bidding for the amount of the allowed secured claim. That will continue to be the law. I don't think that was an inroad into that settled area of the law. But the bankruptcy code under 363K does say that the court, with cause, can limit it. So my caution to the buyers of debt is that once you do that and you really want to own the property, you really want to control the property, is make sure that you're very careful what you do to not give the court cause. My reading of what Judge Gross did in Delaware was that the buyer of the debt became a little bit too aggressive, overreached a little bit. The amount of the credit bid that they were going to do was $75 million based on $168 million full amount of the debt. There's nothing wrong with that. That was a reduction. But they made the credit terms the sale terms 24 days. So to try and sell the whole business in 24 days was aggressive. They couldn't give the judge any reason as to why they felt it needed to be done in that period. And it wasn't fiscally related because the case, because it went into 2014, so it wasn't a December 31 date. And then the next thing is they insisted that it be a private sale, not subject to higher and better bids as an auction. And so that really limited who could help buy those assets for a certain price. And then the final thing was that there were 3 buckets of assets that it was crystal clear that they had an undisputed security interest in. A bucket of assets where there was a dispute over the security interest. And as a buyer of debt, you always look for doing your due diligence. Where is the dispute in buying that debt? But then the third point was that there was a whole bucket of assets where it was unencumbered, and they expected their credit bid to also cover that instead of bidding a certain amount of cash for the unencumbered assets. But I think the Fisker case is one that every single one of you should read, understand the implications, and be able to think through and get the right legal advice as you're going through this in order to understand those issues.
I think the Fisker case, my read on that, and we studied this pretty carefully because We acquired debt in a business recently, and we're taking it through a bankruptcy currently, and a small company. But the issues, on Fisker, came to the fore because it happened. That decision came out right before we acquired the debt, and our key was the lien search was absolutely important, making sure that we had really good collateral and that everything we thought we had was absolutely every T crossed, every I dotted. The things like the private sale and the timing of the sale, if those get extended in a bankruptcy case, it's usually not such a big deal really, because you want to get control of the assets eventually. So okay, if you have to spend more time, if you have to have a real auction, if you have to have creditor groups ability to ensure that the liens are actually all good and all that kind of stuff, that's okay, because the ultimate thing is you want to buy the assets. In this case, they got really chilled because that really hurt their ability to end up owning the company, which is what their ultimate goal was. So the key is, I think, make sure that your documentation package, liens, etc., is absolutely perfect before you buy debt.
And in buying the debt, you as the buyer of the debt have the opportunity to go back to the company, try and restructure it, give them a forbearance for a certain period of time, and in that process, review the problems, get additional collateral, and get additional protections. Lenders do that all the time. Traditional lenders review the strength of their loan portfolio and of their collateral before they then start exercising their remedies. As a buyer of the debt, you should be doing the same thing.
Okay, so Durc, from an investment banking and financial advisory perspective, as we've seen recent decreases in credit quality, and in particular a surge in covenant-light loans in 2013, and what impacts do you see this happening in 2014 and beyond on the restructuring the business as a whole, as well as distressed investing opportunities?
I think that the question we discussed was, is it good or bad for this group? And I would say the answer is both. And where you sit, this is one of these situations where you sit is where you stand. If you're an investor and you're accessing covenant-light debt, it's a great thing, because you've got far more financial flexibility, and a company that's experiencing a temporal operating issue doesn't have to come to the table with its lenders and deal with the fees and related to that type of activity. If you're an advisor like many of the people in this group, it's not great, because in a normal covenant loan, it provides ample opportunity for you to get hired by creditor groups and companies and to actually sit at that table and advise your clients. The thing that I think sometimes people miss, there was a longitudinal study I think done by Moody's. There is a view that covenant-light debt is going to have an inferior recovery experience vis-a-vis covenant loans. And the assumption is that because the company is allowed to run off the tracks for a long period of time without a sit-down with its lenders and other advisors, that's going to ultimately reduce the intrinsic value of the business. The reality is, and these longitudinal studies have proven, that the recovery experience is actually is more or less in line for covenant-light loan and a normal covenant loan. There has been an uptick in the last 12 months. In fact, I think we're at record levels of outstanding speculative grade covenant-light loans in the bank market. So that's frankly going to make it harder for all of us to stay actively employed advising banks, or at least in situations where the activity is triggered by a covenant default in the loan market. Having said that, I think if you're an investor, you're probably pretty happy that covenant-light loans are available.
Well, I think we echo what you say, is that we're sort of, it's like a double-edged sword, right? Because there's fewer deals that are coming available for us to potentially be investors in because of the covenant-light loan situation. I mean, I don't know what the statistics are, but it's an increasing issue. There's no defaults, so there's really no activity. There's no distress. There's no, even people thinking, hey, maybe there should be another investor brought in here. On the other hand, as an investor, arranging capital structure of a new acquisition, oh yeah, absolutely, I'm going to go for covenant light as much as I can. I mean, in fact, I didn't even know if interest rates are really my biggest criterion in looking at a credit package. I'm looking at, where is the ability of my firm to work with the lender if things do go bad? Because if things do go bad, that's when our capital is very much at risk. And boy, we sure don't want to have a loss, and we want to have people that we know how to work with well. And Covenant Light certainly makes that a lot easier for us.
Well, yeah, I was going to say, echoing what Duncan's saying, from a capital structure perspective on a new investment, it can be very important, because in the world of distress, you're not going to make your return on a couple points of interest in your capital structure. You're really going to make it on how much leeway and liquidity you have to get through a restructuring and do the turnaround, and Covenant Light certainly helps that.
The study that Durc was talking about, we talked about it this morning, and I'd love to see it bifurcated into kind of the big versus the smaller companies, the small to mid-market, which is really where I play in most of the time. Because I think Covenant Light deals on the FA side of the house makes it more difficult for us, because granted, some of the large companies with a much more sophisticated management team, they could probably work through the issue with the right partner, with the right investor, and so on and so forth. But I find that the smaller companies, sometimes the management team, the business they've outgrown the management team. The management team needs some horsepower, needs some help, until such time as somebody forces them, or the trigger, the covenant trigger forces them to bring somebody in for that help. Very often I think the companies will go off the rails. So if that study was kind of split in half, I'd love to see how it would affect the kind of the big versus the small.
I think a part, and I'm sorry to interrupt, but I think a part of why we don't see some deals that we think would be distressed hitting the marketplace to invest in is because they already have like some private equity investors involved in them. In some cases, I've seen some deals coming out to market now that have been distressed for heck, 4+ years, because they've had a private equity investor there supporting the business, trying to get a chance at getting their capital back or getting some kind of return on their investment. So, the notion that Cov Light is a bad thing that leads to lower recoveries for lenders, well, I'm not so sure. If it's got a private equity investor, I think it's the private equity investors there trying to protect their investment, which then protects the bank investor.
Which a lot of those investments were probably done pre-crisis, so the price paid was higher to get recovery. Then they have to wait and build up the business, after going through a downturn. So it's just taking longer.
Well, Durc was mentioning to us earlier during our pre-meeting about a specific case where the asset value was high, and so the specific loan was Covenant Light, and that would make sense in that type of a situation. And that's what I'm curious about, is in the Covenant loan, where the covenants are light for a traditional lender, which tends to be making this. What kind of loan-to-value ratio do they have? Are they more than adequately protected? I represent a lender right now where there are no covenants that can be breached, and the only thing that is out there is the interest payment. As long as the borrower makes the interest payment, there is no ability to foreclose or to be able to bring in a receiver or do anything in order to, or until there's a maturity to do anything to protect it. But as long as the asset value is maintaining its own, it's fine. I had one loan that I represented the investor committee in the Mortgages Limited bankruptcy. It was a $900 million loan portfolio held by the hard money lender that went into bankruptcy, and the investors committee did its own plan, took possession, and started enforcing it. And so we had a number of loans to have to be able to go out and enforce, but we also had to borrow money ourselves in order to continue the operations and to be able to foreclose on the properties and sell them. And the lender that we got had no covenants, and it was monetary payments only, and they didn't even have foreclosure rights, because their loan, they only were lending $20 million on the face value of a $900 million loan portfolio. So those may be frustrating for various parties, but it was a really good loan for the exit lender in that specific case, with no covenants and no foreclosure rights.
Okay, so being mindful of the time, I wanted to make sure we budgeted a few minutes here to take some questions from the audience. Do we have any questions?
We're telling you everything.
It's lunchtime.
Lunchtime.
Okay, hearing that, I guess we have time maybe for one more question to the panel. So, with an uptick in everything that we've just been talking about, an increase in covenant light loans, Cathy, can you share your perspective in terms of a shift that you've seen in terms of in-court versus out-of-court restructuring or asset sales?
I think over the last 10 years, and I go back 10 years, but it could be 5, there has been, you've probably noticed it too, a real shift from bankruptcy restructures, even though most of our Chapter 11s, 95% of them tend to be sales, whether it's in a plan or whether it's in an auction. But changing from the bankruptcy as being the forum to changing to state court receiverships or federal court receiverships if you have assets in more than one state. And federal receiverships and state court receiverships give you the ability to sell the assets as long as the issues aren't too complex or involve too many different parties. And it tends to be a very good remedy for certain types of situations. Assignment for the benefit of creditors is another area. There are some states like Illinois, for those of you who are from Illinois, that are really good states based on the common law for assignment for the benefit of creditors, where an assignee comes in and then he turns around and sells the assets. Those could be opportunities for FA or other restructuring personnel to help the assignee or to help the receiver be able to best position those assets and restructure them, or work through the operational issues to restructure them for sale, to maximize the sale in a receivership. So there are opportunities out there. It's just the venue and the forum where it's going to be pursued, which is the question. And usually the lender gets to decide if it's going to be in a receivership or not, because that's a lender-enforced rights under most of the security documents.
What I've seen is some of the state mandate or regulated restructuring environments, whether it be the ABC or whichever receiverships, is they work great if you have assets contained in one area. Our challenge was when we were trying to prosecute something outside of the Chapter 11, but we want to have some kind of a structure in place. It's if there's assets that are in different states, and it was always that complication in doing that. So more often than not, we just decided to do something outside of a filing in any way at all. And in my business, in the last handful of years, go back 10 years, probably 70% of what I did was bankruptcy work, and I think that's shifted just the other way around now. We're probably doing 70% of our time out of court, and 30% of our time not only in bankruptcy, but some state-run process as well. But we really try to keep companies out of bankruptcy these days because of the cost factor and so on and so forth. And
so part of it depends on the appetite of the buyer and whether or not they're requiring a free and clear type of order or sale, because that's sometimes what drives it. But a lender would push somebody into a receivership, and then the buyer comes along subsequently, so you then sometimes have to change stream and go over to the bankruptcy court to accommodate the buyer in order to get a free and clear order. Some of it depends on if you have real estate or not. If you don't have real estate and you're dealing with other types of assets, you can do your UCC, Article 9 sale, as a mechanism. But if you're in a state that has title companies, oftentimes the title companies for the real property sales will require some type of free and clear order.
Well, can't you do a deed in lieu type of transaction for real estate?
You certainly can do a deed in lieu, but a deed in lieu also means that if there are junior liens, those junior liens stay on the property. So if you're the senior lien holder and you do a deed in lieu and take back that property, it's subject to all of the liens.
Yeah.
So deeds in lieu have been increasing. There were a larger number of deeds in lieu, but you have to do your due diligence as the lender or the buyer of the debt that then does the deed in lieu in order to make sure that you've gotten the right title insurance, because you can get title insurance for that as well, to make sure there are no junior liens underneath you, and mechanics liens. Those can be a nightmare as well.
Yeah, we're doing, in the distressed arena, we're doing smaller deals, as I mentioned, and so they're usually deals that are smaller than our typical platform investment size. We'd like to see companies that are 50 million in revenue and higher, and I'm talking about, we're seeing distressed deals that are smaller businesses than that. So we want to pair them up with, kind of get a bad co out of the distress situations and get a decent co or good co to marry up with, and those tend to be great opportunities. And so when you're doing a small company bankruptcy, cost is a really big issue. I mean, going into Delaware as a senior lender, trying to get it through bankruptcy, you've already paid for diligence to acquire the debt. Now you're back in an auction again, and you're paying for all the costs of the bankruptcy, all the advisors, etc. It gets to be very, very expensive. So always looking for opportunities to stay out of court. If possible, it's a lot less expensive.
But we're similar. We try to stay out of court as much as possible, just because the cost becomes so high that it really eats into the liquidity or the return thresholds on the deal. We'll oftentimes also see that in a lot of situations, because of the abundance of capital now, that a lot of prices are set by the debt that are so high, because a lot of times, again, the hedge funds have purchased the debt. They have a certain threshold that they'll credit bid. I know there is the Fisker case, but we still see enough cases where it's just right above where a typical new buyer coming in would pay. And again, so we're trying to do things out of court, but there's still the threat of the debt above that credit bidding, so they tend to take things over.
When you guys say you try and do them out of court, do you try and negotiate the transaction out of court and then wash it through a quick proceeding? Or are you talking about fully out of court?
Fully out of court most of the time, just because a lot of times in the situations we're looking at, unless there's a big liability that's specific to a business, a lot of times we're not trying to flush the trade. So we're going to negotiate with the banks an appropriate capital structure, interest rate, whatever it might be. And so what are we really getting out of the benefit of that? Because we'll do the diligence to figure out what the liabilities are.
Well, and to put it in legal terms, it's whether or not there's a fraudulent transfer, whether reasonable equivalent value has been paid. You guys probably provide or obtain opinions on reasonable equivalent value, fair consideration has been paid.
Yeah, if you have union underfunded pension issues. I mean, if you're in Canada, you can do a quick flip, which is actually a nice way to do it. It's much better up there in these kinds of circumstances. Down here in the States, actually. We do a fair number of deals up in Canada. About a third of our deals are up there. But it's how much hair is there on the business that sort of dictates what you're going to do. If there's a lot of hair in it, bankruptcy is really the place to be. If there's not so many issues like you're keeping your trade whole, that's a great place for a private foreclosure sale, something like that.
And a lot of times we're not buying the debt. We do that if we can see a path to control. So if we're not buying the debt, the minute we go into bankruptcy, it opens up a process. And a lot of times what we're trying to do is bring speed and certainty. We'll bridge deals with our own lines of credit off the fund. We'll have indemnification, reps and warranties expire at closing, so there aren't any post-closing issues. So all of that gets opened up into bankruptcy, and a lot of it doesn't make it through bankruptcy anyway. But it opens up to a whole other arena of buyers, and we don't have exclusivity. So that's a lot of times why we'll avoid it.
Okay, so last chance for any questions of the panel. Anyone? All right, well, thank you to all the panelists here today for sharing your insights, and hope everybody has a great lunch. Thank you.